So Andy, I thought maybe you could give us your perspective. I've talked to a lot of peers at SaaS and cloud companies, and kind of their scenario planning, wargaming kind of seems to end up with, we're going to go raise another 10, 20, 50, $100 million, in a couple months when the markets settle down. What are your thoughts on the reality of fundraising in the current macroeconomic climate? Do you think they're going to be able to easily get that kind of capital?
Well, it depends. The answer is it depends. So when economic downturns come, venture people don't stop investing, but they do invest differently, and they do change the metrics on which they are willing to invest. They'll invest at a lower price, or they'll invest only in much more restricted technologies, and you may be off their list. So it's important to understand what they invest in, and when they invest, and how far they are along in their fund, and if they have funds available to invest in all those usual things. But it's also important to understand of the little Venn diagram of your interests and their interests. Those are not the same, and I stress this to folks all the time, and they often seem surprised. Well, don't the venture people want us to be successful? Yes, but they also are in it to get a return on their investment. So they're with you, and they'll encourage you for 5 years or maybe 7 years, but they're investing out of a fund that has a 10-year life typically. And so they want to invest in years 1 and 2 and 3 of their fund, and then they want to harvest in years 7, 8, and 9 of their funds. And so where their fund life is matters. So they may be they may be more in the harvest mode with you at some point, and not interested in putting additional money in. So it's understanding that your interests and their interests are overlapping, but not identical is critical in that. And the world has also changed, right? We're in a world now where they're just going to be much more selective about who they invest in, and the valuations are likely going to be lower. All that said, one last point: if you think you have 18 months of cash left in your runway, you probably don't. You probably have 15 months at best, because if things go straight south, there's payments that need to be made to close out a firm, and those are not insignificant. You have to make all the payroll and all the federal taxes and things, or those come out of the directors and officers' pockets. So, just be aware that the worst case scenario we talked about a while ago, you want to plan, if you're planning for that, plan for having the cash available to close down in an orderly fashion. That's at least 3 months of cash.
If you had to narrow it down to 3, what do you think the 3 metrics that most VC and PE firms are looking at when we're kind of an economic contraction in the scenario that we're in right now, whether it's for M&A or purchasing equity?
I think the cycle we were in before, everything was based on growth, and you needed to grow like crazy, and net dollar retention and gross dollar retention needed to go up and to the right. No question about it. As we're now entering in more of a downturn, I think what investors are going to want to see is, how are you managing against that? And in particular, is everyone, from what I've seen, a lot of people focus a lot on churn, because that's the canary in the coal mine. If you can't get customers to stay because your software isn't that great, then there's a problem with this company. I think that's number one. From there is managing your spend is the next big item that I think investors will care about. So ratios like CLV to CAC, and understanding your CAC, profit margins, all those original fundamentals, those are great to start managing against, because investors are going to want to know that you're spending the money responsibly and that you can manage that. Where finance really kind of comes in here is saying, here is all the worst case scenarios that could potentially happen. Is that realistic? And if it's not, then you're golden. But if it is, you need to find a plan around it.
Let's take a couple questions from the audience. I want to make sure we get through a few of these. One of the ones that we got was, how do you think about the rule of 40 in this environment? Anyone want to take a shot at that?
Sure, and just thinking about it, if in the old days, 200% growth and 160% loss was met the rule of 40, and you were golden. I think that world has changed for most of us that are working in this space. And now it's like 40% growth is okay if you're breaking even. You know, that's an exaggeration to make a point. You know, it's certainly shifted that direction. I don't think the rule's gone away, but I think people are not as focused on growth at all costs and saying, let's talk about growth at appropriate costs and defining what that is. Cash runways need to be extended. You know, what can you do to do all those things? So it applies still, of course, you know, still want to have dramatic growth, but I think it's shifted, the metric has shifted down a bit on the spectrum.
I think, Steve, it depends on the purpose that we're trying to use this for. If we're going to market with M&A or potentially even an IPO, it's probably pretty critical just from the implications of what it has on everything else. But I would say in terms of priority, things like churn and your profit margins and those are better indicators of an investment or an acquisition or something like that. And the rule of 40 is simply an output that people have certain expectations of.
Got it.
Yeah, and on my end, you know, we're trying to grow as much as humanly possible, but the two major metric on our end is hey, how much cash can we bring in to slow the burn, and if we grow, if there has to be a level of year-over-year growth, and it may not be like, you know, the 40% rule, but as long as there's growth and we can you know, slow the cash burn over time or extend the runway, that is key for us at the moment.
One of the things you brought up a little bit earlier, Wayne, I want to come back to because there was a question from the audience on this, was the 409A. So one of the questions that we had was, when's the best time to do that? Do we assume the downturn is at the bottom now? Do you wait for a deeper recession? Like, any thoughts on timing for the 409A? Anyone want to take that?
Yeah, we just did that. We had a company that they've seen compression in the market, and the board said, you know, we're coming up on a board meeting. We have all these options to grant. We should do an updated 409A. We usually do it annually, but
yeah,
it's down. So we should do that for the benefit of the employees, for all these reasons. So we did, and it lined up. You know, the comparables were down 16%, and our price on the option grant was unsurprisingly down about 16%. So I think the market conditions call for that, and it's not like it's yes, it's optional. But let's think about why we do 409As. We're supposed to do those so that the board can then approve a price that reflects the fair value of the common share that's being granted in the option. You know, there's some requirement that the board has, you know, is saying is giving the right number there. So they have an obligation to deliver that, and the consequences really don't come back on the board as much as they come back on the individual from a IRS tax standpoint. So you want to grant it at the right thing. There has been compression. If you haven't updated your thing in a year, it's probably the right thing to do before you grant more options. And there will be some explanation to your existing people. Well, why didn't I get that? Well, you know, the truth is, if it's in this case, it was, you know, like $9 went down to $7.50. $1.50, if the company is successful, won't matter. But using the $7.50 as the right value now is that's kind of a requirement. I mean, from the IRS standpoint, you want to get that right. So you may need to do it more often as the things continue to, if things continue to decline, and it's something to be aware of and sensitive to, for sure.
Okay, thanks, Andy. Next question that we had was, how are valuation models changing as a result of the changes in the economy? Anyone have a perspective on that one?
Yeah, I'm happy to kick us off, Steve. You know, it depends on what type of company you're looking at. If you're looking at small startups, small businesses, a lot of them tend to use the valuation methodology of, you've got ARR, multiply it by a multiple, boom, that's the valuation. Now, if you're a big publicly traded company, well, then you've got, you know, your NPV with DCF analysis, and you need the risk-free rate, which is from the 10-year treasury. And so there's a lot more implications there. So it depends on which angle you're looking at. But from a big company perspective, it'll probably take a bigger ding to valuations. However, your focus on ARR and cleanly and easily presenting data is a better boost in valuation for the small side businesses.